We're back, live in studio with Samuel Ezerzer in the business headquarters of Radio Shalom, 1650 AM in Montreal, with the Money and Business Show. You have questions about your personal finances? You need advice in making sound financial decisions? Samuel and his guests are ready to take your call at 514-738-4100, extension 200. And now, back to the Money and Business Show.
Today we have former Assistant Treasury Secretary Dr. Paul Greg Roberts. My next question, there's a lot of things that I wanted to ask you concerning, but Dr. Paul Greg Roberts, can you discuss the triple bubble implosion coming to the United States economy? I know you write that extensively on your website, but can you share with us some of the discussions that you had?
Yes. Well, first of all, since the Federal Reserve is fixing the bond price, the bond price depends entirely on the ability of the Federal Reserve to print ever more dollars to purchase ever more bonds.
Okay.
So anyone who wants to clear out of bonds and dump the bonds, the Fed simply buys them to prevent the price from going down. So, in other words, the bond price is dependent entirely on the Federal Reserve printing money to buy up the bonds to keep the price high. Now, the Federal Reserve is splitting this $1,000 billion of new money between U.S. Treasury bonds, which means they're financing essentially half of the federal deficit. It's monetized, they're printing money, and between mortgage-backed securities, which means they're buying these things off the banks, giving the banks cash at face value for bonds that might be worth half that, if that much.
Wow.
Well, this means the bond market is a bubble. It's based only on the Federal Reserve printing money.
And buying.
Now, where does all that money go?
Yeah.
And many times, historically,
the stock market
through the banks into the economy and drives up prices, and people have a hyperinflation. But in the United States, in this instance, it's not. It's stopped in the banks because they're not lending, because the consumers are so over their heads in debt they can't borrow. So what are the banks doing with all this cash that the Federal Reserve is giving them in exchange for their bad assets? They're speculating the stock market. They're buying stock market futures. So just like selling a futures contract,
they're buying up.
Drives down the price. If you buy, it drives it up.
Right.
So the stock market is based also on the Fed's liquidity. It's the fact the Fed is creating money is the reason the stock market is up. It's not because they're selling more or that retail sales are high or that consumers have any money to buy anything. It's simply because the Fed is creating money, it's going into the banks, they're not lending it, they're speculating the stock market. So that's the second bubble. And the third bubble is the dollar itself. We already touched on this. We said that if you're printing 1,000 billion new dollars, but the demand for dollars is not rising by 1,000 billion, then there has to be pressure on the price of the dollar. And we talked about how they have stopped that pressure from the bullion markets by selling naked shorts, and they have stopped the pressure from the Japanese yen and the euro because they have forced the Japanese to print money too. You know, Japan announced not long ago that they were going to print money even faster than the Federal Reserve. And of course, the European Central Bank is now printing euros, even though it's prohibited from their charter. So if Washington can force the other two large currencies to print money as it prints money, then there's no real escape. You can't go into gold and silver because they drive it down. You can't go into yen because the Japanese are printing that. You can't go into euros because the European Central Bank is printing that. And so this is the extremes to which Washington has gone to protect the dollar from the quantitative easing policy, the only purpose of which is to save four big mega banks. So you see that the economic policy of the entire world is directed at saving four mega-sized U.S. banks.
Could you name which ones they are? Just
well, it's J.P. Morgan.
J.P. Morgan, Goldman Sachs.
J.P. Morgan Chase, Citibank, Bank of America,
Goldman Sachs,
and Goldman Sachs.
So those four, at the expense of the stock market, at the expense of the bond market, and the expense of the U.S. dollar.
Yes, and of retirees.
And the pensions.
5 years since retirees have had any interest income.
So what's going to happen? I mean, there's going to be some social unrest out there? If something...
It's a massive bubble. It's a house of cards.
Okay.
At some point, it's going to collapse. I don't know when or what. It's gone on longer than I thought it could, Sam.
Yes.
But, the world is accustomed, use the word accustomed, to the dollar as the favored currency, the safe currency. It's place they flee to whenever they get worried. And that tradition carries on, even though it's being undermined by the United States itself.
And this all started with deregulation at that time, right? I think with George Bush at that time.
It started with financial. Well, the financial part started with financial deregulation, which began in the last few years of the Bill Clinton administration. It was the Clinton administration that was the last year or two that they repealed the Glass-Steagall Act, which separated commercial from investment banking. This was the most important financial legislation that had ever been passed.
So
they repealed that, and since then they've done other things. We probably don't have time to go into it.
No, we won't have time. I know.
So, but on the destruction of the jobs, of the destruction on the ability of the economy to create jobs, we owe this to the Soviet collapse. Because when the Soviet Union collapsed, it caused Communist China and Socialist India to change their mind. They decided, well, look, it's the United States that was successful, not the Soviet Union. We better get on board with them. So they changed their policies, and they opened their markets to American capital. And so the Americans found out, well, look, instead of paying this guy in Detroit $25 an hour, I can hire a Chinaman for 25 cents. And look what will happen to the profits. They'll go way up, and I'll have massive multi-million-dollar bonuses. And the shareholders will get rich, and they'll be happy, and I'll be in power for a longer time. And so that change is what caused the jobs to be shifted out of the American industrial centers into China. And then the rise of the high-speed internet, so that you could send massive amounts of data with the speed of light over a computer. This let all of the firms employing college graduates hire Indians and others who could do the same skill for a fraction of the salary. So this then stopped the employment growth of American university graduates. This is why so many of the graduates can't pay their student loans. It's why student loan debt is the worst debt in the United States. And it's why more than half of recent college graduates are back home, living with their parents in their old childhood rooms. And because the only employment they can find is a bartender or a waitress. And that's that kind of job. The jobs that they studied for were moved by the corporations offshore to China, where they can hire software engineers, researchers, designers for a fraction of the American wage. The Americans can't work for the price of an Indian or a Chinese person because the cost of living here is so high. You can't pay your car payment. You can't pay your utility bill. You can't pay your rent or your mortgage. You can't pay the grocery store bill. And so you have these two things. It was the offshoring of the jobs, which they said was free trade. It's going to make us rich. All have a new economy. Yeah, a new economy of unemployed, educated people.
Dr. Roberts, just maybe you have maybe 1 or 2 minutes. What are we supposed to do? Where are we supposed to invest? Especially, I know we can't predict the future, but just in 1 minute or so, can you tell our listeners what should we do at this point?
Well, I don't have any idea. I don't know what to do myself. There's no answer. Once governments become lawless, they can take whatever they want.
Okay. So
they can do whatever they want. So suppose you buy gold and you have it stored here. They can decide, like Roosevelt did in the Great Depression, that you had to turn the gold in at a fixed price set by the government. Okay. And in the minute you turn the gold in, they revalued it. They almost doubled the price.
Wow.
So
basically there's nothing...
If you invest in stocks or bonds, you're in a bubble. You're waiting for the bubble to burst. When is it going to burst?
We don't know.
You'll never know. You won't ever get out. So even if your paper profits go way up, sooner or later they'll be wiped out when the bubble bursts. In real estate, you can go in real estate. Nobody has any income, no jobs. They can't buy a house. Why would you be in real estate?
You're right.
So no one knows.
Yeah, it's a vicious circle. But today we have former Assistant Treasury Secretary Dr. Paul Greg Roberts, co-founder of Economics, and recent author of The Failure of Laissez-Faire Capitalism. You can find them at Paul Greg Roberts. That's PaulCraig Roberts.org. I want to thank you very much to discuss the triple bomb and discuss the future of America, where it's going, and hopefully you'll come on again in the near future. Thank you.
Sure, Sam. I'd like to congratulate you on your show and wish you the best.
Thank you. My name is Samuel Ezerzer for the Money and Business Show on Radio Shalom, CJRS 1650 AM in Montreal. We'll be right back in 2 minutes.